This video is about different risks related to financial modeling in a project finance transaction. Okay, so I'm giving a webinar tomorrow with the Project Finance Institute on the review of project finance models, and I came up with this new slide about the different risks related to financial modeling task in a project finance, and I thought of practicing it here and maybe also sharing it with you. So before I get into the topic, let me just emphasize on the importance of financial modeling in a project finance transaction. If we go and look at the definition of project finance from Investopedia, it tells us about, the typical definition of project finance is the funding of long-term infrastructure, industrial projects, and public services using a non-recourse or limited recourse financial structure. So the key word here is non-recourse and limited recourse, okay? So in simple words, all these stakeholders that are involved in a project finance deal, they need to rely on a set of projections. The project company or the SPV has a zero balance sheet during the due diligence before construction. There are still no assets that if things go wrong, people can go and claim, ownership of those assets. So there is a high level of risk related to this type of transaction. And the whole story of project finance is how to mitigate the different risks related to different aspects of the project. And the financial model is a tool that gives us this set of projections, okay? And all the negotiations, the financial clauses that are included in the loan agreement, in the concession agreement, in the shareholder agreement, in the joint development agreement, all these type of agreements, they basically refer to the financial model for the financial, aspects of the deal. So what are the risks related to the financial model? So the first risk that I have identified here is the obvious one, is the mechanical risk. How to mitigate? So once we identify the risk, it doesn't matter, we understand the risk, we identify it, we should not go and turn around the problem. We'd rather go and right away find the solution, which are the mitigations. So the first thing is to basically build our model based on the set of standards, financial modeling standards, okay? So in early 2000s, some really pioneers, they came up with a set of standards. They identified the problem of errors in the models, and they have identified this problem, and to mitigate it, they came up with a set of rules, simple rules that can, help us to have a more structured models. These models, remember, are based on Excel, and that the industry has this love and hate relationship with Excel, because Excel is such a flexible tool, and our transactions require this type of flexibility. But flexibility comes also with error. So there are, when you work with Excel, you can make mistakes. That's a fact that everybody is aware of. So to mitigate these risks, so as I said, one thing is to adopt these financial modeling standards, and to make sure that the model is based on this financial modeling standard, meaning that it's error-free. We do reviews. So the keyword, the solution is to review. So sponsors, developers, when they build the model, the first version of the model in the early stages, first of all, they need to, have the internal reviews to make sure that, all the team, they are okay with the model, with the mechanics. And hopefully when the model goes hand in hand within the team, they can identify if there are any inconsistency, and if there are any mechanical errors, it will be captured at that stage. So that's the less, riskier stage, if you can, make sure that the model is risk-free in terms of the mechanics at that point. If not, let me go to my chart, this one. So if not, this is the early stage when the model is still in the hands of sponsors, developers. And then as you proceed with the evaluation of the project, then you will need to go and see the co-sponsor, and then they will also review the model. You will need to send it to lenders, and they will do a different rounds of review. And hopefully throughout these different rounds of review, if there are any errors, mechanical errors in the model, it will be captured during those review. And then at the later stages of the project, really just, 3 months, maximum 6 months before financial close, lenders, they require the model to be audited by a third-party auditor that will need to put its stamp on the model and say that the model is error-free in terms of mechanics and assumption. But since this is really, the audit is coming at the later stage, we want to make sure that the model, goes through these different rounds of, checks and reviews, so that hopefully by the time it gets to the hands of auditor, it doesn't have at least mechanical errors in it. The other thing to include is to make sure that the model is error-free, is to include a set of checks in the model, error checks or integrity checks, to make sure that the model, is free from error. At least the things that we can identify, sources and uses should match. This is one of the checks. Balance sheet should balance. Debt needs to be fully repaid. Debt service reserve account, they need to be fully funded throughout the project. So these are the typical checks that you want to include in the model and show your users that, at least the model is working properly. And then, of course, even though the model has integrity checks, we will still go and check the model mechanics during the review sessions that we have on the model. So these are very important things. Just to show you, one example of the mechanical errors that can happen. Let's say that this is the model we have. We have defined the capital expenditures that are required. These are the uses of funds. And they are correctly, reflected in the model. Everybody agrees about the development cost and the construction cost to be included in the budget. However, let's say that somebody comes and put a, hard-coded figure in the CapEx payment curve, okay? So the lump sum CapEx amounts are correct, but the payment schedule, there is a mistake in it. Here, let's say, for example, we have, instead of, what is required to make the payment profile 100%, we have a hard-coded figure that makes the model, the payment curve to be 98.9% instead of 100%. So we are underestimating the CapEx basically. And let's say that nobody catches this error. So we go to the construction and we are building so remember, once you identify the CapEx, then your facilities are sized, your debt and equity are sized based on this CapEx that you have defined, right? So you're basically underestimating your CapEx, and you have underestimating the amount of financing that you need. So when you go to actual construction, at some point you see that you have cost overrun that is accumulating, and you don't know why. You go back to your model and you see, there was a glitch in the model. You didn't, have the right sizing of your facility. So you see that these things, and this is a simple model, you can see that you can review it and capture. But when you're dealing with a very, complex model, detailed, this kind of error, maybe, it might happen that people cannot capture it, and it's such a disaster if we have cost overrun just because of an underestimation of the cost due to mechanical errors in the model. Okay, the second risk is related to the inputs, and this is also kind of an obvious risk. Everybody knows that when you build a tool, it can end up being garbage in, garbage out if you don't have the right inputs. So how to mitigate that risk? Well, you need to make sure that you have a justification for each and every input that goes into your model. To ensure that this is the case, what you can do is when you are building a financial model or when you are reviewing a model, you want to include a sheet within your model. You can call it references, data, whatever you want to call it. But this sheet is basically keeping track of the references for each and every input that goes into your model. Okay? And remember, when you are having these different round of reviews on the model, whether it's the lenders, sponsors, between the sponsors, all of them, one of the, key critical questions that they will ask is, where did you get your data from, right? So having this sheet within your model is going to also reduce all this question and answer on the model. And, people, they will understand where you got your data from. And if they still have a question, they can go and, point out that I know that you got this input from your, from the lender's agreement. However, since it is still not signed, we want to be more conservative and have a higher interest rate, for example. So documenting and taking track of the references of your input is a good practice that I really recommend. But the key point here is to keep updating it, because when I recommend this to people, I see that they insert that in their model. It is there for the first version of the model, but as they progress with the second and third version, and things are happening very fast in a project finance model. So sometimes they forget to update this sheet and it becomes useless and redundant. So don't do that. Whenever you're updating your model, make sure you go back and also check this sheet and make sure that you have the right justification for each and every input that goes into the model. And I would recommend set it up at the very early stage. Don't wait for at the later stage. Even if at the early stage, most of the assumptions are basically your own internal assumption, or, you did a web search or based on benchmarking, just put it there. If you got something from an email from someone, put the name of that person. Don't take the responsibility. Switch it to someone else, rightly so in this case, because you got it from someone else. So, reference that person that gave you the data. And, this is going to give you some confidence about, your inputs. And one thing that you need to consider is that we cannot be 100% right about each and every input that goes into the model, right? It's impossible to predict the future. That's humanly impossible to predict the future, right? So there will be some errors in the inputs and in your projection because of the assumptions. You cannot avoid it. However, at least at each point in time, you need to have a justification for the assumptions that you are putting in your financial model. So keep track of the references that goes into the model, and that's going to basically and update and maintain it. So that's going to basically mitigate this important risk, which is the input risk. Okay, the third risk that I have identified is what I call maintenance risk. Let me go to my previous slide. You see, throughout the project lifecycle, during the due diligence, you need to maintain and update this financial model. This financial modeling task is not a one-time task that the early stage you hire a consultant, you ask them to build a structure, a financial model for you that has all the flexibility that you want, that can take you throughout the project life cycle and don't be done with the modeling. So every time somebody asks you, you just send out that same version of the model and that will be it. It's impossible. Things are dynamic, things will change, and as things changes, the financial model need to also change with the project and with the realities of the project on the ground. So maintaining the model is also a risk that you need to mitigate by having, a flexible model. So the way to mitigate it is to have a flexible model and to have a financial modeler or financial modeling company that can take ownership of the financial model, can help you throughout the project life cycle to maintain the model, make changes. There might be some simple changes, there might be some structural changes in the model in each stage of the project. So you need to have that, flexibility in the model and have that, person within your team or a company accompanying you that can maintain the model. So that's a risk that you need to be aware of and make sure that you can cover it throughout the project life cycle. The last point that I want to mention here is what I call the perspective bias risk. What I mean by that is a financial model needs to reflect the different points of views. So the financial model needs to look at the world from the lender's point of view, from the government point of view, if there are any kind of concession agreement or anything involved, or government in general, if they're involved in the project, the financial model needs to reflect their point of view as well. And also sponsors, co-sponsor. So that's something, the flexibility that you want to make sure that the model has. So from day one, when a developer, a sponsor builds the model, they need to understand that at some point in time, they need to send that model to these different stakeholders. And these stakeholders, they need to be also be able to use that same model. I insist on the same model to assess the viability of the project. If that model does not satisfy the requirement of any of these stakeholders, and especially lenders, they have a big say in the fate of a financial model, they might decide that they want to rebuild the model from scratch, and this means additional costs and delay just because you didn't anticipate the requirements of lenders for this transaction. Or what can happen is that if sponsors, they can, not agree on rebuilding the model from scratch, what's going to happen is that the lenders, they will build their own version of the model, and of course the projects pay for it. And apart from the cost side of it, the danger is that you will have two models, one lender's version, one sponsor version, totally different structures running at the same time, throughout the project life cycle. So you need to maintain these two versions of the model at the same time. So this means that, more errors and more, kind of headache of having these two versions of the model. So in order to avoid that, how you can mitigate that, again, it all depends on the capacity, financial modeling capacity, within the evaluation team. You need to have someone that from day one understand, where this project is going. That's why personally I am so much against separating the work of building the model and doing the negotiation using the financial model, because once you do, once you separate these two tasks, then the person who's building the model will not understand what are the realities of the project. So you might end up with something that is not really realistic from somebody's point of view. And that's something that you really want to avoid. So these were the points that I wanted to mention here. Of course, tomorrow during the webinar, I will go deeper into the other aspects of the review of a project finance model, but this is it for the risks and how to mitigate the risks. And there might be some points that I missed. So if there is something that you want to add, please make sure that you comment, and hope to see you next time.